FedEx this morning raising guidance for its fiscal first quarter, citing strong demand for international express and ground services in spite of continuing high oil prices. Shares of the company up sharply here, $2.21, 81.51. Joining us this morning now is Don Broughton. He is transportation analyst at A.G. Edwards. He's in St. Louis. Good morning, sir. Nice to have you with us.
Good morning, Chad.
What's behind this hike in guidance? They say strong demand on the international express, ground, and less than truckload services.
Well, I point out there's a couple of things. First of all, this is the fourth time in the last 6 months that FedEx has raised its EPS guidance, which is extraordinary.
Did you see it coming?
Well, we've been on the high side of their guidance range, and this morning, based on their guidance, we moved again to the high side of their guidance range. That's been a place that we've been very comfortable with for FedEx. When you look at the volumes, internationally, transatlantic volumes are up 12% in the last 3 months. They are up 14% last month. Trans-Pacific is up 15% in the last 3 months, up 17% last month. If you look at specific airports, Hong Kong, for instance, which is the second, about to become the first largest cargo airport in the world, it's up 17% year over year, and it's up 25% in the last 3 months. So the bottom line here is international air freight is strong, and it's accelerating.
What can you infer from that about the individual economies of some of these countries?
Well, I think the point to be taken away is that's volume in and out of the United States to all those countries and all these other economies. The weak dollar valuation is driving manufacturing. I mean, our thesis really has been since November, December of last year that the baton of leadership, if you will, for the economy got handed off from the consumer to the manufacturing economy in the United States. And the truth of the matter is that most on Wall Street have never seen a manufacturing-led revival in the economy. The last big manufacturing revival we had really was the 83, 84 time frame. And I don't know about you, Ted, but I was studying college, a student in college at the time.
Well, I wish I had been, but I was already past that. Let me ask you, is it too simplistic to also think that with the oil and gasoline situation being what it is, more people are perhaps ordering online or by catalog and doing a little bit less in the way of shopping at the mall?
Well, that certainly could be one explanation for it. When you get to FedEx specifically, oil is, or fuel is really only 6% of their operating costs, and right now their fuel surcharge program adds 7% to the cost of shipping a package. So if you spent $20 to send a FedEx envelope, you'd spend $1.40 in fuel surcharge. So net, while fuel's more expensive, unlike passenger airlines, FedEx, the cargo airline, is being able to pass all those costs on.
Where does Brown fit in here? To what extent is UPS a factor, and how about it as a competitor?
Well, UPS is a strong, viable competitor. They certainly have a fuel surcharge program in place as well. Although I would tell you that when you look at the complexion of the business mix between these companies, UPS is more in the business-to-consumer, the B2C and the C2C marketplace than FedEx is, and FedEx is more in the B2B marketplace. It's more industrial and manufacturing-based than most people realize.
What does this do for your rating and estimate and target here?
Well, it continues to be buy, and our target is based upon our expectations of earnings. So obviously as earnings expectations go up, so does the target.
Is 81 starting to get pricey for this stock, or not, given the earnings expectation?
No. This morning, before we raised earnings expectations, the price target was 88. And we upgraded the stock back in February. Certainly we've had a nice 20% run since, but we still see significant upside.
So bottom line, in a very otherwise difficult market, if I'm looking for some place to put 5 or 10 grand, you're saying to our viewers this might be a safe place to do it?
Oh, absolutely.
Is there a downside here? What's the risk factor?
Well, the risk factor always is that we have a significant economic slowdown, and that it and its significant competitor get involved in a price war. But they have been very, very disciplined in not starting a price war, as has UPS. And as long as that continues, and as long as we see the manufacturing economy in particular continue to expand, I don't see any reason why they won't continue to deliver the results.
Very good. Good to have you, sir. Thank you.
Thank you.
Don Broughton is a transportation analyst at A.G. Edwards, joining us from St. Louis.